The general rule for taxation, and I'm going to be specific here to foreign corporations, but the general rule is that a foreign corporation isn't taxed in the U.S. on its income, and the shareholder isn't taxed on their income. And so what I want to do is let's start by diagramming out a little bit of how the code is structured. So there's a general rule, and what that general rule says is that if I earn income in a foreign subsidiary, I get to defer that income until such time as it's repatriated. But the code is also designed to have two series of transactions or events that it will deem the income to have been repatriated. When I say deemed to be repatriated, what I mean is it's a deemed dividend back to the U.S. taxpayer. The first series of transactions are really an income statement type transaction. Sorry about the size there. The second group is really what I'll call a balance sheet type transaction. The income sheet transactions, the income statement transactions, fall into, I'm going to call it three categories, but there's probably far more than that, but there's three that are fairly easy to define and three that most people will run into, or at least two of the three they'll run into. The first group is something called foreign-based company income. Foreign-based company income, we're going to call that active trader business income for the most part, and it's an active trader business that's conducted through a foreign-based company, and that foreign-based company is entering into a transaction in such a way that it results in deferral of income that could have, in theory, been earned by the U.S. company without any adverse operational consequences to the U.S. company. The second category, which actually it falls under the same general Subpart F rules that the foreign-based company income does, but it has to do with passive income. And so I'm just going to call this, for our purposes, foreign personal holding company income. This is going to be passive income. This is going to be dividends, interest, rents, certain royalties. But for the most part, these are the things you'd expect to see at your stockbroker in a portfolio account. And then there's a third category here, a very broad category that I'm just going to call other. And this has got stuff in it that you may not see all that frequently, but they're items that have been abused in the past, and therefore they've found their way in here. And just to give you some examples, foreign-based insurance transactions or insurance premiums can fall into this category. Certain boycott income if you're participating in an illegal boycott could be in this category. Bribes and kickbacks can fall into this category. And again, these are all going to be transactions that are found on the income statement and vary from the general rule being no U.S. tax impact. If I fall into one of these income statement categories, then what happens is I'm deemed to have had a repatriation back to the U.S. The final group is the balance sheet group, and this one's a little bit easier. The balance sheet group, for the most part, are transactions that are recorded on the balance sheet that look and feel a lot like a dividend. And I'm just going to call this, basically investments in U.S. property. That's not U.S. parent, but U.S. property. So investments in U.S. property. And these are balance sheet transactions that occur. They don't run through the income statement. They run just through the balance sheet, but they're of a character that results in a deemed dividend back to the U.S. And so what we're going to go through is I'll give some very high-level examples of each of these three now. When I say these three, it'll be the foreign-based company income, foreign personal holding company income, and the investment in U.S. property at a very high level, and then we'll give a separate video for each one that will explain in greater detail what each of the laws is trying to affect. So with that, let's see here. Let's clear, and then let's go through what is foreign-based company income. I'm going to use in this example sales, although understand that there's a whole series of these transactions that can occur, but I'm going to focus just on sales for the moment. Sales of tangible property. And the idea is that if you have a foreign company, so I have a foreign company, and by the way, the company has to be it's got to be a controlled foreign corporation, and if you're not familiar with what that is, there's another video that will explain that. But you have to have a foreign company that's located in country A, any foreign country other than the U.S. And so this foreign company has to basically procure goods that are not from country A, and they need to sell them to customers who are not in country A. So in other words, foreign-based company sales income is income that's derived by a foreign company where the inventory is purchased outside of its country of incorporation for sale outside of its country of incorporation, and this is where the abusive part comes in, and either this person, the vendor selling the goods to the foreign company, or this person, the customer of the foreign subsidiary, is a related party. Now, high level, let me show you how mechanically that can happen. If I were to, and I'll draw it down here, if I were to have a U.S. parent that in turn had a foreign subsidiary, and it had a foreign customer, and just to make it fun, this foreign subsidiary is in, and we'll pick someplace with a zero tax rate, but let's say, or something very low. It's in the British Virgin Islands, and this foreign company is in a high tax or relatively high tax country, let's say such as the UK, close to 30%. So what happens is if the foreign subsidiary buys from outside of its country of incorporation, outside the BVI, and sells outside of its country of incorporation, and either the customer or the supplier is a related party, then I have the makings of foreign-based company sales income. And in this case, the parent company is a related party. So I buy from a related party, sell outside of my country of incorporation, and that triggers the foreign-based company sales income. And we'll give a couple of examples of this in other videos, but it can also apply to services and shipping income and so on. And so we'll try and highlight that as we come across it. So let's talk a minute about foreign personal holding company income. Foreign personal holding company income is a little bit easier to understand, and you can also see it's a little bit easier to abuse. I'm going to still maintain a corporate structure, although this could easily be found in individual taxpayer situations. But if I have a U.S. company and it has, again, a controlled foreign corporation, a foreign sub, all that's required in this transaction, and again it's an income statement transaction, is the foreign sub has to obtain passive income. Now, as with so many things, passive income is maybe a more difficult term to define, and there are a lot of exceptions to it, and there are a lot of nuances to it, but for the most part it's going to be interest, dividends, certain rents, certain royalties, the things you'd kind of expect. And if this foreign subsidiary is obtaining this type of income, then that type of income is defined as foreign personal holding company income, and foreign personal holding company income is a form of Subpart F income. And again, in my example, if this company receives $1,000 of foreign personal holding company passive income, and that's the only activity it has, and there's some exceptions to this rule, but let's assume none of the exceptions apply, then effectively what happens is that's considered then to be a deemed dividend to the U.S. in the amount of $1,000, and the U.S. company will have tax on the $1,000 of income. So again, pretty straightforward. Again, these are the simple examples. Let's go through real quick and see one last example dealing with a investment in U.S. property. Here the concept is that you have a U.S. company has a foreign subsidiary, and the foreign subsidiary is doing all the right things tax-wise, therefore it's not subject to any anti-deferral rules, but it now has accumulated some cash, and let's just say $1,000 of cash. It now looks to distribute that cash up to the parent. Well, if the foreign subsidiary pays a dividend to the U.S. company, that would be dividend income in the U.S. and taxable. So prior to this anti-abuse rule dealing with investments in U.S. property, the foreign subsidiary would simply loan the money to the U.S. Again, a balance sheet transaction, not an income statement. Loan the money to the U.S. This loan shows up as accounts receivable or note receivable from U.S. And again, it's an investment in U.S. property. U.S. payor makes it U.S. property. Therefore, this is treated as investment as U.S. property, and it's treated as a deemed dividend to the U.S. So those are the three major categories, and we'll go through each of these in a little bit more detail in subsequent videos. Thanks.